Good morning, afternoon, evening to all of you. Welcome to today's webinar, Navigating Risk, Challenges in Agricultural Commodity Shipping and Insurance Markets. My name is Monika Totova. I'm a senior economist in the Food and Agriculture Organization of the United Nations, and I also serve as Secretary of Agriculture Market Information System, AMIS, a G20 initiative to enhance transparency on food commodity markets. This event is part of an ongoing collaboration between AMIS and International Food Policy Research Institute, IFPRI, that organizes webinars to provide insight into global market dynamics and policy responses. Shipping underpins global agricultural trade, with more than 80% of major staples moving by sea. Yet, in the last few years, maritime routes are facing levels of uncertainty previously unseen, whether from attacks on vessels, climate-related restrictions, or sharply rising war risk insurance premiums. These disruptions matter. Bulk agricultural cargoes are highly sensitive to handling and transit conditions, and physical risks to vessels on cargo can quickly translate into costly claims. Insurance are trial-selling terms, freight markets are adjusting, and in some high-risk corridors, insurance availability itself now determines whether the trade can move or not. To help us navigate this increasingly evolving landscape, we brought together experts from shipping, insurance, trading, and agricultural economics communities. They will share the insights on freight cost, insurance markets, war risk coverage, cargo damage risk, and wider implications for global food commodity trade and food security. To set the scene, I'm delighted to introduce our first speaker, Hidenobu Tokuda, Economic Affairs Officer from the Transport Section Trade Logistics Branch of UN Trade and Development. Hidenobu will speak about UNCTAD's latest review of maritime transport, a publication prepared since 1968 with the aim of fostering transparency of maritime markets. Before I leave the floor to Hidenobu, I would like to remind the audience that to participate in our online question and answer session, please submit your questions on ifpri.org, Facebook, LinkedIn, YouTube, or by using hashtag AskIFPRI on X. With this, over to you, Hidenobu.
Thank you, Monika. So I'm Hidenobu Tokuda from UNCTAD Transport Section. So I am one of the authors of Review of Maritime Transport, which is one of our flagship reports analyzing the maritime transport. So as Monika explained, the maritime transport explains the 80% of global trade. Next slide, please. Yes, the maritime transport is moving over 80% of goods by volume. That's why UNCTAD analyzed the maritime transport. Next slide, please. And last year, we covered the three converging transitions in RMT. So we discussed geo-economic transition, environmental transition, and technological transition. So these are contributing unprecedented uncertainty and volatility in the global shipping sector. And today's topic of this seminar is about insurance. So I will focus on geo-economic factor in this presentation. Next slide, please. So first of the analysis about Panama Canal. So during 2023 and 2024, there was a drought around the Panama Canal, and because of the sea water level decrease, they implemented a restriction on the passage of ships for the Panama Canal. And the Panama Canal is important for goods transport, including grains. So in this slide, the map is showing a typical voyage of grain shipment from US Gulf region to Asia. So actually many of them use Panama Canal. Next slide, please. However, during this restriction in Panama Canal, the transit of the Panama Canal, especially for dry bulk carrier that carries grains, dropped significantly, as you can see from the left-hand side. picture. On the other hand, container ship was not affected much because the Panama Canal Authority prioritized more on container ship rather than dry bulk carrier. But because of this decrease in transit, dry bulk carrier had to find other routes to transport grains to Asia. So many of them goes to east, like they are passing through the Cape of Good Hope, and some of goods are transported by land to the west coast of US, and then they are shipped from the west coast. But this added more transport cost, and this would be eventually passed on to the grain price for the consumers. Next slide, please. Another disruption is actually still happening in Suez Canal. So because of the attacks on ships around the Red Sea, there is a decline in the ship transit in Suez Canal. And this map is showing a typical voyage of grain shipment from Black Sea to Asia. And as you can see, also many of the ships use this passage, Suez Canal. Next slide, please. However, because of the attacks on ships, the number of transits in Suez Canal declined significantly. So in the blue line, it shows the transit of Suez Canal, but it declined a lot. But alternatively, they went to Cape of Good Hope. They went to goes around the African continent, goes around Cape of Good Hope. So the transit in Cape of Good Hope actually increased a lot. However, of course, this increased a lot of transport costs. Next slide, please. So this picture is showing growth rate of dry bulk seaborne trade, but in two measures. One is in terms of tons, and one is ton miles. And you can see ton miles increased more than tons. And this actually reflects the increased distance of shipments because ships are going around Cape of Good Hope, so they have a longer distance to transport grains from US or from Black Sea or from Europe to Asia. They have to go through Cape of Good Hope, so it increases the shipping distance, and it translated into higher cost of transport goods and then higher prices for the food in Asia, but not only Asia, but globally. Next slide, please. This is also showing the situation of the ships positions before the disruption, after the disruption, but you can see a decline of ships around Panama Canal and also around Suez Canal, but ship positions around Cape of Good Hope increased. Next slide, please. This slide focuses on the Black Sea region before the war in Ukraine and after the war in Ukraine, and it also shows that the decline in passages around the Bosporus Strait because of the impact of these geo-economic factors. Next slide, please. And this is typical indicator of dry bulk transport cost, but as you can see, it is highly volatile. So the main message here is that the transport cost for transporting grain is highly volatile. For example, it started from 1,000 in 2023, but sometimes it goes more than 2 times higher, 2,000, and it goes back to 1,000, and again it's 2,000. So it's really highly volatile market. Next slide, please. And what is affecting this volatility? And of course, external shocks like climate change and the geopolitics is impacting this. But another factor impacting this is aging fleet. Next slide, please. So because there is insufficient investment in shipbuilding. So fleet of the bulk carrier, not only bulk carrier, but also other fleets are aging, and actually the age is reaching the peak of the historical peak. And if so, under this condition, if there is new shocks or some increase in shipping demand, then these old-aged ships must be deployed more, but then these ships have higher cost to transport goods, so it causes volatility in the shipping market. Next slide, please. Also, next slide, please. So under this heightened uncertainty condition, we need to be prepared for these fluctuations. And to address these ANKTADS is preparing a new project to to build a capacity, to build preparedness. Next slide, please. So our new project will create some tailored simulation tool to assess the impact of disruptions or assess the impact of new policy in like investment, to understand the impact of these disruptions and to understand the policy effectiveness in advance, and then equip policymakers to address these uncertainties. And we will start from Kenya as our pilot country. Next slide, please. So as a summary, the disruptions are now a recurrent feature and uncertainty is new normal. And under this situation, we need to develop efficiency, and digitalization is a key to increase our preparedness. And of course, under this situation, the role of insurance is becoming more critical now. So this is, thank you. This is the end of my presentation.
Thank you, Hidenobu, for the presentation and also for staying on time. So we are up to a great start, which leaves us more time for the discussion. I would like now to bring in Veit Husman, Chief Analyst from the International Union of Marine Insurance, who will speak about insurance and risk transfer. The floor is yours, Veit.
Thank you, Monica, and good day to everyone. And thank you, Hidenobu, for setting the scene, because I think you touch upon very important points that we as marine insurers have to deal with on our everyday life. But before we look at our statistics, I would suggest we dive into the first slide and kick off. Because I want to show you and tell you a little bit about Ayumi itself. You can see that we are a fairly old lady. We have just had our 150 years anniversary 2 years back. We have been founded here in Germany, in Berlin, by 2 German underwriters, and now are located with our secretariat in Hamburg. You see a picture of us at the secretariat down in the corner. We are only 6 people employed directly by Ayumi, but we represent basically the whole global marine insurance community. And we are distributed fairly evenly. If you look at the map, you can see that Europe is very strongly represented. I think it's fair to say that London and especially Scandinavia is still a very big important hub for cargo and also hull machinery and energy insurance. But you can see when you look over to the east that our presence in Asia is fairly well distributed. 30% of our premium globally is being generated in Asia, which underlines how important that region is for us. If you look to the west, you see that we are also represented in the US and by Canada, but also in Latin America and South America, which is fairly new. Only in December last year, we have moved Alsum, which is the local association network, from an affiliate to a member status. And now we have strong representatives in most of our forums and committees also from that area. So 42 national, not yet, could we go back one more? Thank you. So 42 national associations around the globe. Sounds more than 6 people in the secretariat, but the real force behind Ayumi is so much more. So we have around 140 members of insurance companies that work directly in our forums, in our committees, because we are there to facilitate and help as secretaries to the forums and committees. But the real work is being done in these committees. And you have to imagine, if you're an insurance company like Allianz or like AXA, HDI, just to name a few, and you are a member of your national association, be it wherever, then you can, as a member of the company, come to IUMI and participate and work with us in these forums. So we have groups of 15 to 20 people that deal and talk about their subject. So we have a legal and liability committee, for instance, a policy forum, we have a salvage forum where we only discuss matters around salvage. We have a data and digitalization forum. We have education and ESG working group. So it's all the aspects that IUMI or that marine insurance is concerned about is being discussed by the experts, and they do it voluntarily. They don't get paid for that. They do it because they believe it's a good platform. So to give you a real hands-on example, container ship fires is a real big issue for not only the ship owners, but also for the insurance companies that have to pay for it. And this is why we come together and discuss, okay, what can we improve on the standards on these ships that these fires won't happen, or that we detect them earlier, that we can prevent them. Seafarers are not firefighters, so we want to make sure they are safe. And we have an opinion, and IUMI is there as a local voice to external bodies like the IMO in London. Our mission is therefore to level the playing field, to join the policy debate, and to form position papers. Now we can move on. So what is important to us is that we don't only want to talk to insurance people, and even though we are only for marine insurers, but we also invite other affiliate members, and we have currently 21. There is some signs on the right-hand side. So BIMCO, as the Ship Owner Association, the class is involved in us, International Chamber of Shipping. So those are affiliate members that are invited, and they can join our discussions as well. We have 36 professional partners. We call them IPPs, and these are, companies that work in the space of marine insurance. It could be law firms, it could be technical firms, but it could be also intelligence providers like, I don't know, Clarksons, perhaps when you deal with shipping. These kind of companies, they can become members, but it's limited to 36 at the moment. And because we want to make sure that the main focus is on marine insurance and not diluted by other opinions that have perhaps other interests. But we want to invite them. We want to hear their message as well. So our core activities basically is to join the policy debate, to formulate opinions, but also we have some insights which we will touch upon a little bit, because I brought you some statistics as well. We have education as well on our products. So we do online courses, and we also have on-site courses 4 times a year, which is basically facilitated by us, the Secretariat, but being executed again by the members who do it on a voluntarily pro bono basis, which is a very good success story of IUMI as such. Okay, next slide, please. If you'd like to get in touch with IUMI and have maybe not heard about us and want to look about, okay, what's in it for me? Where are like the touch points? I would suggest you go on our website and go to the education section where you find webinars and podcasts. I found actually, because I prepared for this webinar, and I found one webinar that is touching upon transportation of grain. You see June 2018. I think it's soon time for a remake. So perhaps you could keep your eyes peeled if there's something happening. So we try to capture all facets of shipping in these sections. There's podcasts as well if you're more of the audio type. And if you have nothing to do with either policy or podcast education, then statistics might be something for you. And I would like to start with that on the next slide. Right, and would fairly quickly introduce the stats report, which I'm responsible for. So statistics, and this is most of our stuff is free online, so please go and check it out. This is a comprehensive 50-page paper or so where we compile our own analysis, but also inject market commentary and opinions as well that you can find. And I brought a couple of slides just to give you short flavor about what marine insurance looks like and how big it is eventually. Next slide, please. So the good news, and perhaps even the most important news here for this webinar, is that you see cargo is dominating our business. Over 50%, and it has always been like that, is cargo. And this is a snapshot of 2024. But you see, it is the biggest line of business and super important for us. So this is why we have a lot of emphasis and do a lot of work on our cargo products, and have also a cargo committee who's dedicated to this line of business. We have hull as well, of course, which is the asset, the vessel itself, energy offshore, and a little bit of liability as well. This is not P&I, so not the big protection and indemnity clubs, but this is commercial liability. You won't find war as a separated line of business here, and I know war is a very interested field for you, because when it comes to shipping to conflict areas, then the war policies are in high demand. But the market is different, and we don't have those facilities, those war facilities in our membership basis. It's a different kind of game. Could we go to the next slide? Right. So the cargo circle that you saw on the last slide now was broken up into regions, and we have fairly granular data. And this is just an example of 2024 snapshot. You see Europe and Asia is fairly evenly distributed. We have the powerhouses China and the London market as the biggest cargo hubs in the world. This is where most of the contracts are being written. You have also strong export nations traditionally, like Germany or Japan, who form also a lot of their own contracts. There's a lot of premium being developed there. In Latin America, we have Brazil and Mexico, and the US is dominated by, North America is dominated by the US very much. So next slide, please. So this is, again, all the premiums. This is not separated by line of business, but here you can see a timely development, which is fairly interesting, because you can see that Europe has been traditionally the strongest market ever. You see, we have been far away from the follower, which is Asia and Pacific. But in recent years, you have seen that Asia is still growing, while Europe is, well, if you look very closely, you could say it's a small dip, but I would say it's rather plateauing. So we see a shift here. This is driven by different reasons. You have to always look at underwriting cycles. You know, here, do you have overcapacity? Do you have undercapacity? Is it a hard market? Is it a soft market? Where are the exports? Where are the trade flows? But here we can see, or at least for now, say, well, you know, business is being driven very much in Asia and also by China. If you drill down on the markets, while Europe is experiencing some era of perhaps let's call it plateauing for now. The other markets, North America, Africa, Middle East, are far off. They're still relevant, absolutely, but there is no really direction visible here. Next slide, please. We don't only collect premiums on the one hand, we also have an opinion on the claims. We actually have a different angle when we look at claims. So this is not major, this is only the major claims from selected countries. So this is not representing the global claims environment, because not every association, not every company feels comfortable sharing that information, but we have at least gotten a relevant number, and I think it's a good mix of people, companies we have here. So this is actually only a short snapshot on a number of cargo claims in different buckets. And what you can see here is, and I just wanted to give you this as a little insight, the smaller claims, so the claims below 500,000 US, is actually on the rise. So this has been increasing in number ever since. If you look at the claims buckets 1 million to 5 million and look at the latest bars, which is the recent years, you see there's a trend going down. And that is in fact good news, because these bigger events, these single events, they are usually fires and weather and NatCat scenarios, so very devastating causes here, while the smaller claims here are more due to theft, robbery, water damage, breaking, denting, and so on. And this is an interesting insight, because what we call attritional losses here is actually a concern, while NatCat, at least what we see, is insure-wise going down. This might not be true for reinsurance and for the whole market, but at least in our data, this is a fairly good news. Next slide, please. So I was appointed analyst, and sometimes I get my hands dirty as well. And I was asked to explain a little bit why claims are getting more expensive. And every company has their insight about why their claims are getting more expensive. But internationally, on a global basis, it is possible to do some work on that as well. And I try to combine steel wage indices with shipyard capacity. And as you can see with the blue line, which is following the red line, which is the underlying claims, this works out fairly well. So this is actually a very good example about what you can do with publicly available data. UNCTAD is a very good source, which I always go back to. So, well, thank you for making a very good work there. This is a very good teamwork. And the last slide, very quickly, on ESG. So ESG is not a lip service with Ayumi. We really do want to join it, and we want to be the voice for our global insurance industries. We have a watch list. We have a working group, and yeah, with that, I would like to finish for now. Thank you.
Thank you, Fred, for the presentation highlighting the shifts. We will keep an eye on how the premiums are going to develop in 2025 when your next update is out, to see whether the plateau in Europe is going to be maintained. So now we move to the panel exchange, and I would like to invite to join me on the screen Dmitro Furda, Commercial Director from Tirayaki Agro in Turkey. Welcome, Dmitro. Brigitte Diacon, Senior Risk and Compliance Analyst from Lloyd's Risk Intelligence. Hi, Brigitte. Thank you for being with us. And finally, Joseph Globus, Research Fellow Emeritus from IFPRI. I will now start this panel discussion with the three speakers that did not present, and later the speakers that presented are going to join us. So before I ask the questions, I would like to remind the audience that to participate in our online Q&A session, please submit your questions on ifpri.org, Facebook, LinkedIn, YouTube, or by using hashtag AskIFPRI on X. So, if I may, Dmitro, thank you for joining us. Good afternoon, I guess, to Turkey. I have my question to you to start from what we heard, particularly from Fight, but also from Hidenobu, is if you can give us a little bit of flavor from your position where you sit as a trader. So, your company operates across multiple origins and destinations. How have relatively recent disruptions, some of those disruptions have been around for quite some time, how have those disruptions in those maritime corridors affected your ability to maintain predictable shipment schedules and to deliver on the commitments you make as a trader?
Hello, Monica. Hello, everyone. Thank you for having me here, and happy Ramadan for those who celebrate. Coming back to your question, it's been a tough sea for the last 4 years when Black Sea is concerned. But since last year, we've also had an increase in tensions over the Gulf of Aden and Hormuz Strait, what altogether stipulate a quite sizable risk for our company that is focusing its activities in the Middle East and North Africa areas. So we've been trying to mitigate geopolitical impact of the war in Black Sea, but now we are having like a task with an extra star to deal with. So talking about the war risk premium, I can confirm that it's been quite stable in the last 2-3 years, not surpassing 1% from the insurable value of the ship. If we translate that in dollars per metric ton, it's gonna be 50 cents to $1 roughly. Almost same in Ukraine and in Russia. And if you look at the Gulf of Aden, we had almost zero extra war risk insurance in 2024, and in 2025 it increased to 0.5%. It is event-driven situation, sporadic drone attacks that come from Russia and from Ukraine in return, and also the Yemeni situation impact the timely changes in the war risk premium. But in a longer term, we see the impact as very subdued. Current freight levels from Black Sea to Turkey and to North Africa are not very far from the multi-year average. What says us that there is no much insurance premium inside the freight quotes that market is using, but it is rather increased voyage time that is very hard to predict, and that is what creates more headache and financial losses to market participants. For instance, when we are buying grain from Ukraine, we have to consider, number one, extra 15-20% buffer in time, since the country is experiencing continual blackouts and continual air attacks, and we have to foresee the alternative origins in our contracts to make sure our supply and our commitment to the end of takers is secured. So it's been challenging period, although we are always hoping for the best. We are prepared to deal with the situation hereinafter by applying those tools I mentioned, and also by hedging our freight exposure. And we also seeing that owners are not actually willing to call Black Sea ports nowadays, since they are not earning as much of the money they used to do in early 22-23. And talking their language, the risk doesn't worse the money doesn't worse the risk, and they prefer alternative geography for their business. Thank you.
So if I understood properly, it's not the war risk that is the trader that is bothering you. It's more the increased shipping time and port delays and things that are affecting logistics, but that are not necessarily related to insurance. Was my understanding correct?
Yes, it's a bit of a puzzle where both insurance and geopolitical situation correspond to the big chunk of risk, but it's not insurance on its own.
So before we move to Bridget, perhaps you could explain in agriculture trade how those small policy shifts and port delays can show up as higher bases and longer lead times in shipments?
Yeah, I would love to. The policy changes have had a significant impact on the logistics, on all types of cargoes being transported by sea, and not only. Port interruptions, the blackouts, military escalation, and also the policy shift, as you rightfully underlined, create this scarce predictability for a trader and for the market operator during their activities. For instance, it's been circulated a few weeks ago that Russian Ministry of Transportation is planning to ban the vessels that used to call Ukrainian port or Romanian or Bulgarian port during their last 10 voyages, all vessels with Ukrainian or Azerbaijani crew on board, or vessel coming after the dry dock repairs. It's becoming very difficult to satisfy those terms, and potential exposure for a trader that sources grain from the region can be translated into the default by not being able to provide that kind of vessel. And if the vessel is finally provided, no one guarantees how long the inspection by special services may take. So for that case, if we see that piece of legislation being adopted, 15-20% of time buffer is not enough. And there should be some additional margin for and expenses taken into account. Thank you.
Thank you, Dmitro. Let's now move to Bridget. Bridget, you are in your work as a senior risk and compliance analyst from Deloitte's List Intelligence. You have worked a lot on the sanctions and in geopolitical conflicts and maritime risk exposure. So I would like to take advantage of you being here with us today. So how should agriculture exporters and importers evaluate vessels and counterparties operating near sanctions jurisdictions or those high-risk corridors? Some of them were already mentioned by Dmitro.
Yeah, absolutely. It is a really good question, because I think people assume that there is no risk in the agricultural commodity space. But there is, especially in the Black Sea, obviously, with the Russians using the ports in the occupied territories. So my advice really would be for people to be familiar with who they're doing business with. It sounds really simple, but I have spoken with people in the past who have, agreed to buy grain, and then throughout the process, they realize that they have been misled on where that grain is coming from and where it's being exported from. So they're told that it's coming from Kavkaz, which is in Russia, but in reality, it's coming from Sevastopol in occupied Crimea. So my advice would be to be vigilant if something seems off when you're doing a transaction, if certain checks are being missed, perhaps, to really investigate and to push back, because people are really actively trying to deceive others in certain spaces. And another thing I would say to do is to track ships with AIS data, which is vessel tracking information. Essentially, it's really important to follow shipments from start to finish to make sure that everything makes sense and that there's nothing else kind of going on. Cargo's not being picked up that you weren't aware of or unloaded somewhere where you didn't agree to. I mean, we definitely get cases where bulk carriers are manipulating their location data. So they'll look like they're unloading in Oman or Sohar specifically in Oman, but they're actually in Iran. So it's really important to be proactive in kind of the risk and due diligence space.
Well, you mentioned AIS, which is the automatic identification system. It became quite in a vocabulary these days. So, and you also mentioned sanctions. So how pervasive are sanction-related evasion tactics, like this manipulation of the AIS system, dark port calls, also spoofing? Maybe you can also explain to our listeners what is spoofing among vessels that handle bulk agricultural commodities.
Yeah, it definitely exists. It's not super common. It kind of depends on the trade, and I'll go into some examples of where it does happen. But in the occupied Crimea or occupied territories trade, for example, you will see dark port calls. So these are going to be examples of vessels that disable their AIS sometimes for weeks at a time. And the purpose here is to go to places like Sevastopol. They also go up to Mariupol and Berdyansk in the Sea of Azov, and those ports were taken at the start of the war, and they'll pick up goods and then export them internationally. But it gets complicated in that they also do ship-to-ship transfers with this grain. So someone will pick up something from Sevastopol directly with their AIS off, and then maybe someone with their AIS on will do a ship-to-ship transfer with that vessel, and they'll end up taking the grain from Sevastopol or Mariupol and deliver it. So people could still be exposed to risk further down the supply chain. It's not necessarily, for the one ship that's doing something kind of deceptive or perhaps a little naughty. It's a ship from earlier on. So you kind of have to watch across the entire space. So again, this is really, really common when we're talking about exports from Sevastopol, Mariupol, and Berdyansk. It's not just limited to that. And fortunately in that space, I should say it's mostly dark port calls. So it is fairly obvious to pick up a direct caller. It's the STS, the ship-to-ship transfers that make it tricky, because then the grain starts getting mixed together with Russian grain and it's really hard to follow. In terms of spoofing, so spoofing is when AIS information, so positional data, latitude, longitude, coordinates, are being manipulated and falsified. So, for example, as I just mentioned, we will have bulk carriers that'll sail down and they'll look like they're berthing in Iraq or perhaps in Oman, where in actuality they are in Iran. So it's not super common, but it does happen. And this partially has to do with sanctions and partially has to do with reputational damage. It's a bit of a gray area, but again, something to watch out for deliveries that are going to Iran. How are they actually being delivered? Is the AIS on? Is it disabled? That's quite important. And then other places you might see it is Syria. It was really common for almost all the trade going into Syria to be offline during the Assad regime. And you can definitely track shipments from Ukraine during that period where the AIS would be on for them to load in Ukraine, but when they approach the coast of Syria, they turn off that AIS and they work offline to unload. So again, that's not 100% sanctions related. There's a lot of different things at play there. But I think the point, though, is that, this kind of shadow fleet and deceptive activity, it can happen across any market if the conditions are right. And it certainly does happen in the agricultural commodity space.
You mentioned, Brigitte, ship-to-ship transfer. Is it something that is, if you are going to do this, if you are going to transfer grain or fertilizer in an open sea, it seems to be quite technically complicated. Is it still being done, or is it it's an obstacle that can be overtaken?
That is a brilliant question. So it's not. There's not a standard across industry to do ship-to-ship transfers. If you ask anyone who works in bulk industry broadly, they say, no, that's not safe. There's no rules to do this. It's not like oil. However, Russia almost exclusively exports its grain that way. And it's just the way they've been doing it for like 15, 20 years. So they'll move goods down from the Sea of Azov, so Rostov-on-Don. So they'll ship them down on little ships, and then they'll go to kind of the Kerch Strait in the area south of it and move it onto the larger ships, which take it to foreign markets. So it's actually just how the Russians happen to move things in the Black Sea, or part of how they move them, other than shipping things directly from the ports. So it's tricky because, like I said, it is just how they do it. However, they are also using that to hide the fact that they're moving grain originating from occupied territories.
Thank you, Brigitte. So for now, let's move over to Joe. Joe, one of the big part of the discussion when the war in Ukraine started was the implication of the war, and then later we had additional shipping disruptions in the Red Sea, in the Panama Canal, that caused costly rerouting. How do these increased transport and insurance costs translate into global food prices and volatility?
Yeah, no, that's a great question, Monica, and thanks. I think, yeah, there's no question. If you looked at what was going on during the even COVID, but certainly with the war in Ukraine and then the other disruptions, as you mentioned, what you see is that the markets work fairly well. That is, they diversify sources. Importing countries like Egypt were able to get the wheat that they needed at a higher price. Global prices were higher. They had a source from suppliers that were further away than the Black Sea. And similarly with what we've seen in the what's going on with the Suez Canal and Red Sea, that disruption, we've seen very little grain come out of Ukraine now going to the Asian markets like we did certainly prior to the war, but even that first year when we had when the shipping lanes reopened, still a lot of grain was going out that way. And as you say, that increases costs. Hidenobu's chart showing the tonnage miles, we're going up much faster during COVID, but also during the war and subsequent times. And when you impose costs like that into the marketing chain, typically, both sides pay a little bit, both the consumers and the where that cost is actually felt is more often than not felt at the producer side or the exporter side. So a lot of those, in grain markets, we're talking very competitive markets for the most part. So it's hard to pass on a lot of those costs to consumers unless you're a very small importer, and then it becomes, you have less power. You have your reaction to market prices may be such that you end up absorbing proportionally more of those costs than you might otherwise than, say, a larger importer. But certainly, if you look at Ukraine, the impact has been very easy to see in the sense that a lot of those costs have been borne by Ukraine producers ultimately, who are seeing much lower costs. And if you look at that Ukraine, FOB prices, they are considerably lower than a lot of the other competitors in both in the region, that is Russia, but also certainly grain originating out of Europe or France or other places.
Thanks, Joe. You also wrote a blog for the CSIS where you also mentioned the number of 80% global staple crops depending on few maritime routes. It would be interesting to explore where this 80% it comes from, because today we already heard it a few times. So, but regardless what this percentage is, how does this concentration increase systemic risk when insurance markets tighten?
Well, some of that's just because the major exporters, you can count on one hand or so, right? The fact is, if you're looking at world wheat markets, you have North America, you can have US and Canada are big exporters. The EU is a big exporter. In the Black Sea, you have Russia and Ukraine and Kazakhstan to a degree. And then, the Southern Hemisphere, you have Argentina and Australia. And a lot of them take the same paths through what we would call choke points, the Straits of Malacca, which haven't been an issue over the period we've been talking about. They could be a potential choke point at some point, but we've seen how the Suez Canal and the Red Sea has been, not just with the current disruptions, but the blockage in the Suez Canal, 3 or 4 years ago, also created disruptions, those sorts of things. Panama Canal, obviously a very big choke point. But when you're talking about so much of the grain from Brazil, for example, going out, most of that goes through the Straits of Malacca to the Asian markets, to China. Thankfully, those routes have been open and we haven't seen the disruptions. But, when the Suez Canal was closed, you're looking at, for wheat, that's roughly 20% of the wheat. Those markets that were that were getting wheat from, say, the EU or Russia or the Ukraine, found other suppliers, and largely in the Southern Hemisphere, Australia, which sometimes sends a lot of wheat to other Asian markets in East Africa. Argentina, which was sent wheat over that period. So they find it, but again, at a cost.
Thank you, Joe. So now I would like to bring back Hidenobu. So Hidenobu, the report, the maritime report, and UNCTAD a few times highlighted the uncertainty in maritime routes. Which choke points currently pose the most critical risks to agricultural bulk carriers? Panama Canal seems to be all clear for now.
Yeah, but still the Panama Canal, it's the water level recovered, but still there are many bulk ships did not return much to the previous level to the Panama Canal because they are now using other routes, like they are going east via the Cape of Good Hope, or some of them are transporting by land and go to the west coast of US, and they are shipping from the west coast, and they are still continuing rather than returning to Panama Canal. So because Panama Canal Authority prioritizes container ships, and this trend is still continuing. So I think this is still some increase in transport costs. And obviously the choke point is, of course, the Suez Canal is still many ships are avoiding there. And as other panelists discussed, the Hormuz Strait and the Malacca Strait is another other important choke points. And actually, the Malacca Strait, if we look at the map of the ships, then many routes go through Malacca Strait, like Europe to Asia, Brazil to Asia, also the Black Sea. So yeah, it's working now, but in terms of risk, it's a big risk point.
So has there been early on when the traffic started moving more, passing the Suez Canal and around Cape of Good Hope, there were certain concerns that the ports were not around the southern edge of African continent, that the ports were not sufficiently well prepared with this influx of traffic and refueling and other needs that the ships might have. Did anything happen there, or everything went smoothly?
Yes, so actually we are monitoring the port congestion in our indicator, and actually the waiting time is increased, especially in these African ports. So because of this, as you said, the influx of the ships. So, and of course, because of the congestion, it means there is longer time to transport goods, and it translates into the higher goods prices.
If I unmute myself, you mentioned indicators. So given rising geopolitical tensions, what early warning indicators does UNCTAD monitor to anticipate major shipping disruptions?
Yes, so first, as I said, we are monitoring waiting time because it's a kind of indicator for port congestion. But not only that, but we also monitor freight rate, like Baltic Dry Index, because they are very real-time indicator. And also it's not necessarily a indicator, but we are also developing new tools to assess the impact for example, impact of these disruptions on economy or impacts on food security of each country. So we are developing these tools, and actually our new project will develop a new trade model, but it's not only a trade model, but it will include the global shipping network and assess, for example, and with this model, we can assess, for example, the impact of disruption in Hormuz Strait, or it's like a what if simulation. So if something happens in Hormuz Strait or Malacca Strait or Suez Canal, we can simulate these impacts on the global economy and each country and food security.
Okay, so the plan is that it moves from Kenya, which is your pilot country, to the whole world?
Yeah, we hope we need to have secure funding, but for now we have funding for Kenya, so we will just start from there.
Well, we'll be looking forward to the results. So now I would like to bring in Faith. So, Faith, from where you sit, what do you see as the key macroeconomic and trade flows developments that most shaped the cargo underwriting conditions in 24 and 25? On the chart, you only had 24, but I imagine that you are in a position to also speak about the 2025. Over to you.
Yeah, thank you. Well, I mean, currently I'm in the process of starting the collection for data of 2025, because you need to imagine that when the insurance companies close their books, they report to the national associations, and then they can, report to me. And some countries are early on. Sometimes I get figures in March. Sometimes I get figures in August for my conference in September. So it's a bit difficult if you have to reach out globally. But of course, we monitor certain parameters and we have ideas about what steers our business. And if I perhaps touch on the three main points, three main macroeconomic parameters, and perhaps give you a flavor of the direction where we triggered, I would like to start with tariffs. I mean, we have heard it a lot and we are getting tired of hearing it. But this is what is driving us, because the cargo amount or the cargo volume and value is basically what is driving the underwriter that has to sign the business. But fortunately, in 2025, we can stipulate that tariffs haven't really fully materialized. There were exemptions for certain countries. We had seen bilateral deals with the Trump administration and certain other administrations and countries, governments, but also the private sector was very agile when it comes to rerouting their supply chains. You've probably heard about front loading, cargo being rushed to the warehouses. So all these effects, and financial markets, of course, they had a big impact on the tariffs. So many angles here, but when we compare how tariffs impact GDP growth projections, and it depends on who you want to believe, IMF or UNCTAD, there are projections between 2.6 or 3.3%. There's a bit diverting models, but it's good to have an opinion. But even though if you compare those figures, what is clearly, all the figures point that we are below long-term pre-pandemic averages. And that is, of course, negative for marine insurers, because we earn on the top line, and when cargo is en route, then the contracts are signed. On the other hand, we have seen that the US dollar has significantly weakened in 2025. I mean, it started already in January, and you have seen continuously against all major currencies, perhaps let alone the Japanese yen, we have seen that the US dollar has depreciated 15-18%. And for marine insurers, this has several impacts, of course, but when we look at global premium reporting, this is a positive effect, because you have to imagine that the local currency needs to be converted to a US dollar, and then it's being reported to us. And when you have a relatively strong national currency, and you convert it into weak currency, that weak currency has to be more. On the other hand, a claims handler who has to pay a claim has to pay a worker in China to weld certain material, or a certain wage in Europe has to be paid in local currency. And when the US dollar as lead currency and the contract is weak, then it costs more. So there's a bit of that as well. And lastly, perhaps as the third point, I would name new trade zones. Yeah, we have seen that the EU has agreed with a Mercosur trade agreement, and also there has been a bilateral deal between EU and India. Now, this has been a very politically strong sign, and there are calculations from the Kiel Institute or from London School of Economics, and everything points in direction, okay, there will be trade flows going up between those regions. But when we look at the global impact of these zones, I think it will be rather limited for us.
Thank you. So when you mentioned front loading, so front loading in a way you actually like, right? Because it brings a lot of volume to be insured in one go. certainly it affects the trade flows later in the year, but front loading per se, from your point of view of an insurer, is not a bad thing?
No, definitely not. I mean, it boosts the cargo volume as such, and we have seen that China is, for instance, trying to reroute their exports via third countries like Thailand or Vietnam, and that makes it easier, of course, for to not be fully impacted by the tariffs. But I think front loading, I think now it's too late for that, so we won't see this effect again.
So if you can elaborate a little bit, we heard about the start of the war in Ukraine and what were the impact of the insurance. So at one point in about March, April 2022, the grain exports were brought to standstill. So how did the insurance and reinsurance companies find a solution at that point?
Well, I think the installment of the grain corridor was arguably one of the most significant achievements during the ongoing war between Ukraine and Russia. I mean, there's not very much going on right now, but I think that was a very, very crucial part of what has been happened. And clearly, it was a multi-layer approach with many stakeholders and a lot of people around the table and involved. But it would be unjust to say that insurers were the driving force behind the scene. But insurance is irreplaceable for the cargo movements that the grain corridor could facilitate, and that is true for sellers and buyers alike. Without insurance cover, these shipments would simply not take place, right? I mean, think about you buying stuff online. I mean, I always take for granted that my parcel is being insured. When I order something, it gets lost, I get covered. If that wasn't the case, I would perhaps shop more locally. But where is the line when we come to war? Well, it's important to understand that we as marine insurers, we cover risks up to the point where the risk is effectively war itself. So that means insurers do not cover war as such, but we provide cover for the defined risk unless and until the situation qualifies as war. And how can we do that? Well, modern insurance contracts are quite flexible. They are structured with clearly defined conditions and clauses that allow all parties to respond to quickly changing circumstances, including conflict situations in real time. So going back to the question, what happened to Ukraine grain exports? I think as soon as the conflict parties agreed on a designated non-war corridor, insurance cover kicked back in and resumed.
Thank you. So I suggest now we have a discussion with the questions that are coming in. If you do have a questions, please put it in the askifpri.com or Ask Ifpri, or put it on the Ifpri website. In the meantime, I would like to ask Dmitro. Dmitro, although you said that the war risk is not exactly on too high on your agenda at this point, but if you were going to get the insurance quote, how would you go around it? Is it difficult to get a public information on this from where you sit as a trader?
Since it's event-driven environment for the insurance and for the insurance rates, and they fluctuate quite often, there are no reliable source that I have from my trading desk to watch for the insurance on daily basis. Instead, what we are doing is we are contacting our partners, ship owners and ship operators, time charterers, and we address this kind of questions to them. And we also monitor the fluctuation of the war risk insurance throughout our daily or weekly fixtures, which are concentrated more or less in the area we are talking about. So actually our day-to-day work is our source of information. It's not that we are going blindly into the business, but there are a lot of speculation, a lot of talks, a lot of emotions in the market, especially after the difficult days and weeks on the ground, on the battlefield, that, okay, this is the chaos, everything goes up, freight is gonna surge, but we see that after storm calms down in 1 or 2 weeks, we are coming back to a normal environment and business opportunity.
So in this situation, what is a normal environment?
I wish I could answer. After COVID, we've been flying through a turbulent area, and I wish I can see a clear sky nearby. But what inspires me and makes me going further is the ability of a human being to adjust to everything, the flexibility of the origin substitution, the ability of traders to take a hit with a rising freight cost, with a delayed parcels time, with inelastic consuming behavior in Middle East and African countries, which are not very easy to take a substitute origin, let's put it this way. But we are figuring it out at Tsuyaki, and I can say that we've been doing it quite successfully because we are having our volumes piling up to those areas. We are happy that the food sooner or later reaches the destination, even through the Suez Canal, even through the Gulf of Aden and the Hormuz Strait. The cargo flow continues. We do not abandon any geographical areas regardless of the situation. And we are fighting together with all the market participants for the food security all over the place. Thank you.
So the traders are flexible and they have adapted. That's the optimistic conclusion.
Not effortlessly, but they've managed. Yes, we saw a lot of success stories all around, and market is reshaping itself. Market is very versatile and adjusting body, and it will survive us.
Thank you. So on this note, let's turn to Bridget. Bridget, you have been quite active in the open source intelligence. So if you could perhaps say a few words about the open source intelligence, OSINT, and the new sources of data to monitor developments in these markets, freight, insurance.
Yeah, absolutely. So, one thing that's really common is the use of AIS data, and it's becoming kind of a more popular option in OSINT. So using that, we're able to track, really able to track everything as long as the AIS is on and accurate. So we can understand kind of in real time trade flows and rerouting. So I think AIS data is really one of the important and most important use cases. In other aspects, satellite imagery is becoming more popular as well. Again, this is to help us keep an eye on areas where we don't have as accurate data available. I'm sure as many people are aware, there's a lot of GNSS interference, which basically interferes with locational and positional information of AIS, which can make it difficult to track ships in certain areas. So satellite imagery is becoming increasingly important there as well. And another way to understand the market and what's going on is actually social media is really powerful. I spend a lot of time trawling through Telegram channels, especially in the Ukrainian market and the Russian market, because that's where you kind of get really honest opinions on what is going on the ground. So a couple of different options there for anyone who kind of wants to investigate this independently.
Quite labor intensive on you, Kenny.
Yes, it is, but worth it always.
So what anomaly detection indicators does Lloyd's Intelligence find the most reliable when it comes to identifying deceptive vessel behavior?
Oh, it's a very good question. I love AIS data. I think AIS data is so powerful if you understand how to use it properly. And it's really just a matter of getting kind of a notification or a red flag that something is amiss. So on our own platform, if there's an AIS gap, that will be flagged. Instances of spoofing will be flagged. We have developed an algorithm to pick that up. But really, at the end of the day, you have to remember that bad actors are advancing much faster than everyone else because they are pooling all of their time and resource into doing this. And the shadow fleet realistically is a network. And so once they figure out certain tactics work, they do share it amongst each other. So for me personally, I'm a huge fan of just doing kind of, I guess you can say, the dirty work, the hard manual work of looking through that AIS manually. I do it with every single ship I review that I think is shadow fleet or engaging in deceptive activity. And it's really, again, the AIS is so powerful because it gives you exactly what's going on, and you can figure out if something looks amiss and investigate it further. So yeah, I'm a big fan of AIS in all forms, you know, using it and feeding it into algorithms to pick up automatic issues that you need to investigate, like dark port calls, but also, again, so powerful just to watch what a ship is doing, where it's stopping, could it be doing an STS that you're not aware of, all that kind of stuff.
It can be also turned off, right?
Can be turned off, but
Yeah.
that's my favorite thing, because it's an automatic flag. It's, if you're going to deceive someone, turning off AIS is actually one of the silliest things you could possibly do, because it's like, it's almost like saying, please look at me and pay attention to me, because it's disabled. But of course, you know, all of Ukraine's trade, or all the trade to the Black Sea ports, is actually offline because the Ukrainian government mandates it. So you do kind of have to be careful about how you're interpreting this AIS information. But spoofing is a far more sophisticated method of hiding activity, because there is no red flag unless an algorithm picks up spoofing. You really do have to be paying attention to the entire voyage.
Thank you, Bridget. Joe, we have a question here from the audience, which I think you are very well placed to answer. What are the economic impacts of global supply chains on Egypt's food security? I think this question is going in the line that Egypt is the world's largest wheat importer, so importing quite a bit from the Black Sea region. So if you could elaborate a little bit on that.
Yeah, no, sure. And I think it follows up on some of the other comments that were made earlier. But if you look at Egypt, certainly over the last 20 years, they've become, not only are they the largest, or oftentimes the largest wheat importer in the world, they are heavily dependent on the Black Sea. And it's interesting, particularly in 2022 and 2023, when those supplies were disrupted, there were a lot of people talking about, well, what could be done? What sort of strategy should, say, Egypt undertake? And you hear oftentimes, you know, at fora like these, where people will say, well, they should really be pushing for self-sufficiency, or they really should be diversifying their suppliers. And those are all well, and you know, those are, I guess, potentially reasonable scenarios or suggestions, but they all come with a cost. And I think you should look at these strategies like any insurance, if you will. That is, you pay a premium for diversification. That is, you're buying from suppliers that are pricing their wheat or whatever grain higher than you are from the source you want to diversify away from. Similarly, with self-sufficiency, that can come at a very, very high premium, because, you know, encouraging production domestically could just be prohibitive in cost. And in fact, in Egypt's case, it's hard to imagine even how they would actually even feed their population, because it's so large, and they are such large wheat consumers. So I think, you know, again, you need to look at these things. I think one of the big lessons from 2022 and 2023 was the fact that markets work pretty well. That you know, we for a country to shift all of a sudden to say, okay, look, we need to find other suppliers because our main suppliers right now, there's a conflict in that zone. We can't get wheat, or it's too expensive. So to have things like you know, export certificates for phytosanitary certificates and things like that, to have other sources approved for imports, is very important risk mitigation strategy, I would argue. And so that you can turn and to say, okay, we can buy, you know, wheat from France, and we'll bring that in. And yes, we're going to have to pay a little more for it, but right now we can't buy from our usual supplier. So I think these sorts of strategies are really important, and may be a lot more cost effective than just a brute strategy like well, we're going to buy 20% of our grain from this country just because we feel that think that they're a little safer than these other countries. I mean, I think that the experience that we've seen both with COVID, with the war in Ukraine, and then also through the disruptions in Suez Canal and Panama Canal, we've seen that markets have been able to adjust, and in some cases those things are minor irritants and they cause some increased costs, but things normalize once the situation is resolved. And as we see with the Black Sea grain agreement, as we've seen with water, rainfall returning to the Panama Canal region, so that the canal is seeing more normal shipping patterns right now.
Well, when I hear about increasing self-sufficiency, it does always make me quite nervous, right? Yeah. Because increasing domestic production is generally a good idea if you have the conditions to do that, and you can do it sustainably with improved varieties, etc., etc. But when I hear about large countries, large importing countries advocating for self-sufficiency, there is something to be said about the trade. And Joe, while you are still on the screen, there is a similar question from Nigeria: how to best reduce the risk of importing products to sub-Saharan Africa? The question doesn't specify which products, but I assume we are talking about food here and food commodities. So many of the lessons you already mentioned for Egypt also apply here.
Yeah, they do, and I think it is important. What I'm mainly talking about is availability. That is, grain is available, and the world is more than happy to supply grain under most circumstances. I mean, it's very rare that we've seen sort of multiple breadbasket failures and things like that. And then what normally happens even then is that prices rise and that demand is affected because of higher prices, and that is a very big problem for poor net importing countries. I think that's I don't want to make it sound like I'm not recognizing that aspect, because I think for poorer countries, to see a 25%, 30% increase in the price of a commodity means that they will import less of that, or if they do, it has to come out of some other use for scarce funds. And I think those are big concerns. Again, I think the actual strategy of mitigating risks and other things are very similar for poorer countries. I think for big net importing countries, obviously some countries will increase stock levels to a degree. I mean, not such that they can offset a short-term supply disruption. But the problem, again, stocks are very similar to some of the other mitigation methods that we mentioned, that it's costly to maintain very, very high stock levels. So yes, it's important to keep a few months. If you're a big importer like Egypt, you want to make sure you have a few months supply to be able to withstand any short-term disruption. But in the long run, again, it's the seeking of alternative sources, and to be able to switch to other sources if there's problems with your normal suppliers.
Thank you, Joe. We have only about 10 minutes, so I would like to ask both Hidenobu and Veit. Hidenobu, in your presentation, you mentioned that the vessels are aging. All right, that I don't quite remember the wording, but the fact that it's the oldest fleet since 2010 something. So from your perspective, this obviously can create additional shock to the system. So I would like you, Hidenobu, to elaborate a little bit on this aspect of the aging fleet, and you, Veit, on what this means for your market. Hidenabu?
Thank you. So actually, the aging fleet is contributing to actually exacerbate the shocks. So, for example, if there is increase in shipping demand, then first, in order to address these new shipping demand, first, shipping companies would try to use more efficient ships, but these are already deployed. Then they have to, then what is available for them, then they have to use older, more inefficient ships, but these are more costly, then this will add more cost for the transport costs. And especially if you do some microeconomics, the transport cost or prices would be determined by marginal cost. So recently we are seeing a high price for the freight rate, and this is actually partly reflecting this high marginal costs from these older inefficient ships when they are deployed to meet this increase in shipping demand. And when I say increase in shipping demand, it's not necessarily a trade volume increase, but I mean it's includes shipping distance. So, for example, ships are rerouting via Cape of Good Hope. Then this means for us. This means also an increase in shipping demand. So in order to meet this new increased shipping distance, they have to use more ships, and this means they have to use inefficient ships. And but another question is why they are not investing in new building ships, and why the ships are aging. So one factor contributing to it is the uncertainty about environmental. Sorry, one factor is environmental policy is not clear for them. For example, there is a discussion at IMO to introduce a global system to decarbonize ships, and there is for midterm measure, but the discussion was postponed for the 1 year. So for the ship owners, the future climate environmental regulation is uncertain, then they want to see what will come. So this kind of uncertainty is causing this trend of aging ships.
So how long does it take to build a bulk carrier?
Yeah, normally when they have they order new shipbuilding, then it would take 2 or 3 years, but for bigger ships, it would take more years.
Thank you. Fine. Over to you. On the same topic, if you could elaborate on the old vessels.
Yes. So the aging fleet is a little bit like the aging populations. I mean, when you get older, you might need a new hip, or it becomes difficult to walk, and we see a little bit of the same effect with a fleet. I mean, especially our friends from Norway have very good insight in dedicated claim frequencies, and they have analyzed this and found that engine claims is becoming a real problem for old ships. And an engine, I mean, it's real big, most costly part in one of these machines. But it's not only the engine claims, it is also the constructive total loss likelihood that goes up. I mean, if you have a claim that costs around $50,000 and you have it on a new container ship or on a new double hull tanker, and it won't be a total loss. But for older vessels where there's some insured or the vessel value goes down, that can be a constructive total loss much easier, and that is changing the claims pattern for us insurers as well. And third point, it comes about technology. New vessels have new technology. They are well equipped, and that can lead to obstacles in, for instance, navigation, right? Because sometimes you have to have certain not security related, but advanced technology on board. The problem with old tankers, for instance, is that we see they often disappear into the shadow fleet. Yeah, they are being used for some trade that is not as insured. Yeah, they call it shadow fleet, but it is not an uninsured fleet. It's just insured somewhere else under terms that is not perhaps not what we might expect or what has been the case before. So this is also troubling, of course, for the insurers, that there's this business disappearing, because not only it means the risk is disappearing, because it can be a good risk after all. Just because a vessel is old doesn't mean it's bad. Yeah, we always have to look at every risk, at every manager, at every ship owner that has different. They define on how much maintenance a vessel takes, and so this is perhaps a good point. Not every old vessel is a bad one.
Let's finish on a positive note. You mentioned good risk and bad risk. So could you, we have a few minutes left, so maybe you can finish on a note, what is a good risk and what is a bad risk from where you sit?
Well, this is a very holistic and very deep question here, and as to have me answer this on the final words is, well, at the end of the day, each and every company decides by themselves what they want to insure and what their clients are, and we see that. I mean, we see that when you work like I on a national or with national associations located around the whole world, yeah, you have a tendency that, for instance, the Nordic portfolio, they insure vessels that are a bit younger, that are perhaps even a bit well maintained or better and maintained than somewhere else in the world. But we speak on behalf of everyone, and everyone is doing their very best to pick the pick the right risks, to give them the best business that fits into their portfolio. So I have to finish up with do very good underwriting, choose your risks well, and take the right price for it.
All right, so we can conclude that the risk, it's a bit like beauty, it's in the eye of the beholder, all right?
That's very nice to say. I like that.
So with this, we only have 3 minutes left. So I would personally like to thank all the speakers that joined us this afternoon, and I will pass the floor to Joe, who is going to conclude and take us all home. Over to you, Joe.
Yeah, no, thanks very much, Monica. And let me also thank everyone, all the panelists and speakers. Monica and I have been talking about having a webinar on this topic for a number of months now, and I'm glad you can see the reason why. This was just a great session, and I learned a lot, and I presume a lot of other people did as well. So let me thank Monica for really setting this up. I think behind the scenes, people you don't see are Alexis Poulin with Amos helped a bit with this. Arnaud Petit at IGC, all these helped identify speakers and gave us some good ideas. At IFPRI, Mabel and Jamed have been sort of the backbone of this series that we've had here, and the fact that it comes off is all due to them. And let me just say that our next webinar will be on April 23rd, again from 9:30 to 11. The topic, we'll announce that shortly and hopefully get some material out on it. But again, this is the first one of this year. We hope to have these pretty much every other month or so. So we look forward to it. And again, thanks everyone for joining.